Good afternoon, everybody. Welcome to our Advanced Option Strategies webcast. I'm Connie Hill. I'm happy that you would join me here today. You know, something that some traders like to do is have several strategies ready to go to attack an earnings play or try to play an earnings. I'm going to teach you a strategy that we don't talk about a whole lot and give you some specific guidelines, but I'm going to keep you on the hook just a little bit longer before I tell you what that strategy is. But I think you're going to enjoy it. In fact, John, it may even help you not be so sleepy. John was saying he was sleepy. So, John, we're going to be waking you up here. I am happy we've got Barb Armstrong in the chat. We're happy to have Barb back. New and improved 2.0 version of Barb. A great friend and fellow coach, and will understand the types of questions that you're going to be chatting in, right? She's a great veteran of the markets. So if you have those questions, go ahead, put them in the chat. I will keep my eye on it, and Barb will pick up some things maybe I can't quite get to. If you're listening to this on the recording and you have a question, go ahead and put your question in the comment section in YouTube, because we go back and look at those throughout the day. Make sure you get your questions answered too. So we'll want you to do that. I hope you're following me on X. I'm Connie Hill CS. Barb is Barb Armstrong CS, and we post educational content throughout the day. Things that maybe you might find interesting or things we want to bring to your attention, we'll share those with you. It's free to do and fairly easy. Somebody's noting we are flipping roles. Yep, Barb is riding my shotgun today. I was riding her shotgun earlier in trading a smaller account. So it's good to see you here. Let's go through the disclosures and then we'll get on with our agenda. Options carry a high level of risk are not suitable for all investors. What we talk about today is not a recommendation. It's just for your education and information. We'll be using some technical analysis. We'll also be looking at some probabilities. Keep in mind they're theoretical in nature. We will be using the Paper Money software application. It's a great educational tool, and it's great to practice strategies on. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. We won't be talking so much about commissions and fees, but keep in mind you want to recognize those and let them enter into the picture of what you're doing here. Now, typically, we'll just take a quick look at market conditions. You guys are probably abreast of what's going on. We're having kind of a little snapback here, a little rally here today in the markets. We're going to discuss a particular strategy that I think traders could put in their arsenal to use over earnings or other big announcements that a company might have. Okay. And then, of course, we're going to lay out a nice little example trade for you. We're also going to put together some guidelines as part of our strategy here. Now, I want to let you know upcoming events that you will want to get to if you're close to these places, or if you can easily get yourself to these places. Make a little mini vacation out of it. Dallas Market Drive event, September 20th. Chicago Market Drive event, October 4th. These events are different than the workshops. We bring in some special guests. They're more geared towards current market conditions and observations we're seeing in the marketplace. Versus a workshop, we have a definite criteria, definite things we want to lay out for you, like in Orlando, October 10th and 11th. So it's a little bit different type of content on these market drive events, but people seem to just love them. So we would want you to enjoy that here as well. All right. On our right here, we have an example of some of the option strategies that Brent will go through in this class, and he does such a great job, I think, making some of these complex trades really understandable and usable. Okay, so the example we're going to use today actually is not one of these, but the one we are going to use is somewhat like a calendar. We're going to be doing a double calendar designed to take place when a stock has a big announcement coming up, like earnings or something else. Okay, this strategy is more designed. There's not much technical analysis that's going to go into it. It's more designed to take advantage of high implied volatility in a front month option that we might sell. Now, you know, a calendar uses the same strike price, but different months or different weeks, okay, different series. And so what we're looking to do is sell the front month or the front week, whichever it is that we're using, and bring in a substantial premium with the idea that if the stock moves that a specific direction, that it'll overall be a profitable trade for us. And I'll show you what we're looking at here. So let's hop over into my paper money. And we'll get rid of the big circle. We'll come over here to our charts and just take a quick look at the markets. And let's start out here with our SPX. I do have it here as about a 6-month chart we're looking at. I've also put implied volatility on the screen because we're going to look at that when we look at a couple of different stocks here. Now, we can see, man, this is a nice, big, snappy bounce back day that we're dealing with here. Looks like SPX is up over 1.5%. So big bearish engulfing candle, engulfing. Man, it's really wiping out a few days of that little pullback that we were experiencing. Something I talked about a little bit earlier was the idea that the SPX, even though we'd had a little bit of a pullback, was still in an uptrend because the low here did not go lower than the previous low. Okay, so yeah, definitely still in an uptrend. And man, it looks like a little bit more. We could be in for a new all-time high here again, which the market seems to do. On the NASDAQ, similar type thing going on, right? It kept grinding out new all-time highs. And the move is still a significant move, even though it's not getting back as high as SPX is right now. Its pullback was a little bit steeper. And so it's up fairly nicely today. What is that, about 1.6 something percent? Looks like the NASDAQ is bouncing. So I'd say overall, yep, our uptrends are still in place. Our low here is higher than the previous low, so still have an uptrend. Okay, now let's take a look what we're going to talk about today, double calendars. How many of you, let me just ask you this, how many of you are comfortable with calendars at this point? I hope you are. This is more an advanced class. If you're not somebody that has worked with calendars before, hang out, keep with us, okay? But there might be a few things that I'm going to assume that you know, that you understand how that strategy works, okay? But hang out with me and chat in if calendars are something you're familiar with. This double calendar that we're going to work on here is really just putting together a put calendar and a call calendar. There's not like a different, something special type of thing. You'll see as we get into it here. All right. Vic says, yep, do every day. Excellent, Vic. Glad to hear that. Isaiah wants to know, how do I select 2 different buy and sell orders to send to the Analyze tab? Ooh, you can send them one at a time, or if there's connected together, say like in an iron condor, and you're setting it up as one trade, you can just hit Analyze Trade, and it'll bring all 4 legs over. Okay. Well, what we're going to do here, let me get a blank piece of paper. We're going to draw some rules out here. I'm going to line it up for you. And these are just really guidelines for this strategy to take advantage of this scenario that I presented to you, right? Something exciting. We're expecting a big move in a particular stock and what we might look for. Okay, so the first thing we're just going to say, criteria is we're looking for stocks. Typically, we'll look here for something over $40. You could go lower than that, but typically I'll keep that as the minimum price. Okay. We also want them to have a lot of open interest. So you might even look for here, something more than you might with your average options. Okay, meaning let's look for volume, average volume of at least, I'm going to say 2 million. Okay, sometimes you might start at 1 million for some of your strategies, but we're really wanting liquidity here. And the stocks that seem, for this particular set of guidelines that we're going to use, stocks that are bigger and kind of well known, kind of some of those big blue chips off the, it could be off the Dow Jones or the S&P 500 or S&P 100, NASDAQ 100, those types of stocks seem to be have the kind of liquidity that we want to look for. And so you'll probably notice some of the names are names that are familiar to you. Okay. Um, Greg says, I'm not too comfortable with them, but I am familiar. Perfect. Yeah. And anytime you're learning a new strategy, man, paper money is the place to try it out. Okay, so we're going to look for that criteria already. And then we are going to look for implied volatility in either the front month or a front week, or the week of an announcement coming. We want the implied volatility. We want to see a mismatch. So we want to see in the front week or month that we sell, we want to see that implied volatility be at least 10% higher than our long leg that we're going to buy on that calendar. So I'm going to say plus 10% high IV in the short leg. So we're going to be selling the front month, buying something a little bit further back. Okay, so that's kind of our criteria. Pretty open. But there'll probably just be, limited number of stocks that really might meet the guidelines for it. All right. So NVIDIA, let's maybe move this out of the way here a little bit. It has earnings coming up when, my earnings flew off here. I'm not sure why I'm not sure. It's because I don't have an NVIDIA up. I have the NASDAQ up. NVDA, there we go. Now we see. They have earnings on the 27th here. It's going to be after the market closes, so that's going to be next Wednesday afternoon. Timing for putting on this kind of a trade, you might consider doing it maybe about a week or a few days out from an earnings announcement, as opposed to that night or opposed to that next morning, so that you have a little bit of time in here, because one of our exit rules, we might actually get out before the earnings announcement comes out. Okay, so we want to be able to have a little bit of time. What happens as a stock starts moving into earnings season? Well, implied volatility has a tendency to ramp up, doesn't it? So we can see on NVIDIA, yeah, it has ramped up. Now, if we were teaching this class last week, could we still use NVIDIA as an example? I'd say, yeah, it's probably still, it's a little bit longer than a week out, but it's still kind of in that time frame when we're expecting implied volatility to probably creep up here a little bit. Okay. All right. Let's go to the option chain next. Now, in the option chain, we have a lot of choices here. You guys know NVIDIA, 128 million shares traded today alone on this stock. So generally, that means the liquidity in the options is going to be there for us. Now, because they announced on the 27th, we want to say, okay, for the series that we're looking at, which is 7 days out, this is the one where the week where the earnings are going to be announced. So this is where we're going to focus on our initial short leg that we're going to sell. And we want the buying leg, which could be out 1 week, 2 weeks, 3 weeks, whatever you want. What we want it to be, we want this to be 10% higher in the implied volatility of what we're going to buy. Now, in our case, we're just going to buy the next week out. We're going to buy that one that has 14 days left to expire. So it's going to be a fairly short time frame calendar that we're working with here. Now, is there a 10% discrepancy on the implied volatility? Yeah, sometimes it's a lot more with NVIDIA. Maybe they're thinking they've got a lot of it priced in already, but there is at least 10%, so you would proceed. If it wasn't at least 10%, then you might want to pass on the trade, or you might want to go out, say, a week further so that you would have at least 10%. So for example, if 54 didn't qualify, the 54% maybe would go out the next week, and this one would be a 50% compared to 65%, would say, oh, okay, good, I have 15% difference here, okay? So that's what we're looking at as far as our strike prices. Now, let's go ahead, let's clean this up a little bit here. And the market maker move, how many of you guys are familiar with the market maker move? It's not on all stocks, but it is on some. Usually it accompanies a big event, but the market maker move is not sitting here yet. There's not a calculation for it. So that means we're going to have to figure it out another way. What is being priced into the options? Now, some of you are going to know this, that we might want to look at the at-the-money straddle to determine what's being priced in. How big of a move is the market expecting? So let's do it the hard old manual way, which is just fine. It's not that difficult. All right. Going to come over here. We're going to open up August 29 options when they're going to have this announcement. And what we're going to do here is find our at the money. So the price of the stock right now is at about 178. And so our closest, let's see here, our closest technically is going to be the 177.50. So that's going to be our straddle that we're looking for. So if we were to buy this straddle, we'd be adding together 660 plus 585. And I'm just going to kind of see if I can just highlight that row there a little bit and pull out our handy dandy calculator. And the amount of what's being priced into the straddle is kind of the approximate move. Okay, so let's see here. We've got 585 on the put side plus on the call side 660. Okay, 6.6, and that's going to, oops, I did the wrong number. I did 6.9. 6.6 plus 585. Okay, 1245 is what the sum of that comes to. And so we'll say, okay, that's what's being priced in right now as far as how big of a move is the market expecting. Now we can come over here and look also at this area here. After the 65%, it says plus or minus 1297. And that is till that week that option expires. Okay, so they're really close in those numbers, but I wanted to show you how to manually figure it out here. Matt says, why are all my numbers different from mine? They might. If you're on paper money, there's going to be a 15-minute delay. We have kind of some hybrid accounts for our demonstration accounts. And so I might be getting real-time data, and you might be having 15 minutes delayed, but they still should be fairly close to each other. Okay. And you can go ahead, you could even write down the numbers that we're using here or not. Now, as I'm looking out in the chat here, looks like we've got a survey already. Now, you guys know we do a survey from time to time, just kind of trying to get your feedback on in this particular session, okay? And so obviously we're not at the end of the class, but if you'll just go ahead and click that link so it's active while the session's going on, then when it's time for you to leave or we close down the session, that'll be there for you. And we always appreciate the time that you take to fill that in for us. Now, Barb will post it again before our class is over. But if you'll do that for me, Matt, I promise to read every single thing you write. Now, given that this is typically Brent Moore's class, if there's some information you would like me to pass on to him, feel free to put it. We've got the 2 radio buttons, plop, plop, and then there's 2 questions you can answer, and you can also use that as space to communicate something, okay? So if there's something you would want Brent to know, go ahead and put it in there. I'll make sure it gets passed on to him. All right. So we know kind of how big of a move that we're looking for here is about $12.45. And it really doesn't matter. We're not looking for some golden amount. Okay, this is just what it is. That's what's priced into the options at this point. All right. Next up. Do we need to use technical analysis here for our entry? We don't. This is not a technical analysis type situation. It's really a volatility play, okay, on this double calendar. Now, what we're going to do next is we're going to say, okay, if we know the move is 1245 and we add a 1245 to 178 and whatever the price is, okay, what strike price does that get us closest to? Okay, now it hopefully is going to be close to a 20 delta. Okay, we'll do one of the strike prices here and just know it's the same price process on the other side. Okay, so for example, we're taking 177.50 is the at the money strike price. Let's start on the put side of things. And so in our calculator, we're going to take one. Actually, maybe we can keep that 1245 there. 1245 plus current price of the stock. I'm going to round it to 178. Okay, I know it's jumping around there. Let's just go with 178 using the 177.50 strike price. Actually, that's not what I wanted to do. Let's do this out. Let's clear this out. We want to take whatever the current price is plus our 1245. But I don't think I did that. 1245 plus 178. Maybe I did. Okay, is 190.45. So on the put side, or on the call side of things, rather, let's go over to the call side of things, where we see this out of the money, because typically these are going to be a little bit out of the money. What is the closest strike price to 190.45? Well, it looks like it's going to be this 190 here, which is pretty close. Ideally, we want it to be around a 20-something delta. Now, this is a little bit higher than that. This is a 23 delta. So just know we're going to be in that range. Okay, it doesn't absolutely positively have to be that exact number, like 190. So we're going to just back off a little bit here. We're going to use, in this case, the 192.50 strike on the put side of things. Okay, so 192.50 on the put side. And then the same thing, or rather, that was the call side. Then on the put side, we're going to do the same thing, right? We're going to take whatever the price of the stock is minus 1245, and it's going to get us pretty close. Let's see what my number was here when I was looking at it earlier. It's going to be pretty similar. I told you I wouldn't do it, but I'm going to. I'll do the calculation here. 1245, and then we'll say a minus 177.50 is 177.5. If it, you cleared the whole thing out. Okay. Sorry. Let's go 178 because we're just using the flat number. 178 minus 1245. Okay, 165.55. So there is a 165 strike price here. How close to a 20 delta is it? This one actually is going to be the closest one in this case. So we're going to use 165 on our puts. So that's going to be our front leg that we're going to sell. So let's go ahead, let's construct this part of the trade. Now, going back to our white sheet of paper here, I do kind of want to keep this open a little bit. I want to write those rules down. Our short leg, we want it to be near a 0.2 delta or maybe slightly less, and it's going to be approximately our plus or minus that we have added on to the current price of the stock. That's the strike price that we're going to be going with. Okay, so we're going to pick the one that's closest to 0.2, and usually that math is going to put you pretty close there. Okay. I didn't really write in the timing here, but I said we could go up to a week in advance of the announcement. All right. And this is going to be the next tricky part. Okay. The next tricky part is that whatever we're selling in that front month on that calendar, we want to make sure that it pays at least 40% of the long leg. Okay, so that adds an interesting twist here. So let's start with our 165. Okay, we are in the selling period that we're going to use. 165, if we were to just sell it right now, is going to be about 169. Okay, so our 165 is going to bring in 169-ish. Okay, and then on the other side of things, our strike that we're going to go with here, move it over, I guess, a little bit more. This one we ended up being the 192.50 on the call side. And if we're selling that, we're going to bring in the neighborhood of 143. Okay, ignore that extra decimal. Okay, we're going to sum that together and see how much credit we're going to receive by the front part of that option. Okay, of course, it's going to be offset by the long leg when we put on the full calendar. So let's go 190. Let's clear this out. And we'll go 169 plus 143. I should have warned you, this is a math heavy session that we're going to have today. Hopefully, if I do the calculations right in front of you, hopefully it'll make sense and you'll be able to follow the flow of this. So we're going to get 312 out of that front month. Okay, now let's go find out our long legs. Okay, well, we know what the strikes are going to be. They're going to be 165 and 192.50. Okay, but let's go look at it. So the one we're going to pull up now is the one that's 14 days out, and that's going to be our long leg. And I'm going to bring our sheet back up here again. We're going to do some documenting. Since I've got the call side open here, let's look at it. So our 192.50 call. So you've got to have the same strike available in the next period that you're going long on. Okay. If not, it's going to turn into a double diagonal. Okay, so we're happy we've got these strike prices here. So 192.50, if we were going to buy that right now, looks like, it's kind of shifting a little bit on us, but look at something real quick back here. I'm wondering if I shifted this and I shouldn't have. No, we were really using 192.50. Okay, so back here, we're going to say, well, how much is it going to cost for the long leg of this? So on the call side, our 192.50 is going to cost $211. And then we'll go ahead and put in the put premium on the 165. So then on the 165, it's going to cost us $236. Okay, so we're going to add that together. And my little math brain said the value of that's going to be $4.48. Okay, so I told you we want the credit we're bringing here on the front legs to pay for basically 40% of the long leg. Some of you eyeballing this are going to know, oh, yeah, that's going to work. But let's crunch the number here, okay? So here, what we're going to do is we're going to say, okay, our credit we're bringing in is 312. We're going to divide that by 4.48. The amount we're going to have to shell out. What percentage is that? 69%. So that those front legs we're going to sell will cover about 69% of the long leg. So that's sitting pretty as far as that one goes. Now, you guys know implied volatility is fairly high on NVIDIA. So keep that in mind. Not all stocks that you might run through this process are necessarily going to qualify, okay? Because it's got to be the ones that have a lot of implied volatility priced into it, okay? So I'm going to just move the rules out of the way here for a minute, and let's go ahead and let's put on this calendar, double calendar. If you wanted, you could put it on one at a time. We're going to do both of them at the same time. So we're going to come out here to our 165. This is the leg we want to sell, and we're just going to say we're going to buy a. It doesn't say double calendar here on this menu, but pick double diagonal and then come out here, select double calendar. Okay. Now we are going to adjust these prices because it doesn't know what we wanted to do. But it did at least put on our 165 long leg out in September 5th, which is what we want. And we've got our strike price here at 165. Now it doesn't know what we want on the call side of things, okay? So on the call side of things, we said we're going to do 192.50. So we're just going to click here. We're going to find 192.50. There we go. And then our other call, it's got to be 192.50 as well. Now we kind of have done a little bit of the math there. We didn't do all of it. I didn't take the credit minus how much it was going to cost it, but this is going to be a net debit of $1.32. Now, somebody asked in the chat, can we see how you might put on more than one spread on the Analyze tab? In this case, it's a full trade. All four legs are there, okay? If you were doing it separately, you would want to highlight one trade and say Analyze, hit the next trade, Analyze, so that they're both on the other side. In this case, we're just going to be able to do Analyze Trade, and we're going to get rid of an old something in there. And I'm going to say hide position. So we only want to see this trade that we're looking at. Now, this is the profit and loss graph here. And I'm going to kind of stretch it out here a little bit. Well, maybe if I float it, there we go. So we see a little bit more definition in it. And so what this is telling us is where the peak profitability is going to be. And of course, it's going to be at our strike prices, right? In a single calendar, if we just were doing one put calendar, yeah, that's where the peak profitability is right smack at the strike price. So 165 here, 192.50 on this side. Kind of looks like a circus tent, doesn't it? Yeah, it kind of does. And then the expectation is once whatever this news is out, that it collapses down and hopefully moves to one side or the other, moves close to 192.50 or moves closer to 165. Okay. Once that announcement is made, we're probably going to make a decision fairly quickly as to which leg or which calendar is going to be the surviving calendar. Okay, if it moves more towards 192.50, it's going to be the put calendar. If it moves more to the 165 here, I take that back. The 165 is going to be the put. The 192.50 is going to be the call. So whatever direction it goes, we're probably going to end up closing out that particular calendar to see what we can salvage out of it. Now, it could be that it doesn't move very far. Well, one of the tricky things with this type of a trade is that sometimes we don't have a lot of time left. Now, on this one, earnings is on the 27th. That's going to be a Wednesday. So on the 27th, we will actually have some time for it to play out to see if it maybe gravitates towards one of the peaks or not. Okay, that's what our hope is. That's what we would like the stock to do. And that's why we calculated how far is priced into the straddle, right? How far is the market maker move going to be on this? Now, I imagine next week when the front month options that expire this Friday are gone, that the market maker move for the earnings period will probably come up on the trade tab, even though it's not there right now. Okay, this is kind of a lot of rules. Okay, I want to give you an opportunity to ask some questions here. Okay, go ahead as you ask, put in those questions because this has been, I know, a lot of rules. One exit rule might be that if the price of this spread grows by a percent you're happy with, whether that be it goes up 40%, 30%, 50%. If it, because of the implied volatility ramping up, if you are satisfied just with that profit alone, nothing's stopping you from taking it. You don't have to play it through the earnings if you don't want to. Okay? You could say, God, I've already got 40% of it and the earnings aren't even out. Maybe you might just be happy with that. Okay, so that can be an exit rule. Another exit rule is seeing which calendar it possibly moves towards, and then basically closing down the loser quickly and trying to salvage what you can and hanging on to the other calendar. Maybe it lands in here in the 165 area or the 192.50 area, and you have to be, there's a lot more discretion that's used when you're closing out when ideally you want to take profits. But you could basically say, man, if it gets close to the peak price, that's our number we'll be happy with, right? this is saying here, if we look at kind of this blue peak line here, this is showing that peak profitability is in the range of about $343. Okay, that's what the value would be. So then, of course, you'd that's what it's showing our profit would be on it. Okay, same thing over here. It's fairly similar. That's looking like 390. Okay, so both of them are quite a bit. All right, let's see what your questions are. Now, somebody was wondering over here, it says double diagonal. It does say double diagonal, but really it's a calendar because we're only using 2 strike prices. Okay, if our strike differences were different, okay, then we weren't using the same one. Say we sold a little bit further out of the money on one of them, then it would be turning it into a diagonal or a double diagonal in this case. Okay. Now, so Riceburg says, so looking at the analyze, we could watch it and cash in early. Nothing to stop you from cashing in early. That can be one of your potential exit points. Is great. You might go, you might be thinking, well, I don't know how much would feel comfortable to you. 20%, 30%, 40%, right? You get to decide what that percent is. How likely is it that it's just going to go perfect to one of those points? We just don't know, right? Stocks have a tendency to do what they want. They respond to news and markets, right? And so it's not like we can force it over there. We just know what's been priced into the move at the money straddle. Okay. Now we could come along here and we could, in our window, we could say, let's click on this gear and get a few more things. We could say, well, what happens by a particular date? So earnings is not till the 27th. We could come up here and change the date. And I'm down here on the bottom right. Okay, we're going to change this to the earnings date. It's going to be 8/27. It's going to be after the market closes. Our thing changed a little bit here. What do we expect the stock price to do? You could put in an adjustment if you had something very specific that you were trying to test out and see what it did to the profit and loss lines. One thing I needed to do here, and I didn't, and we're going to do it now, is this date here. We want it to be the later of the dates. So we've got 2 expiration dates, and it took the August 29th. We're going to change it to September 5th. Okay, so we're going to go ahead a month, and we're going to go to the Friday after the expiration of the one that's further out. Okay, we could also come in here. We could adjust implied volatility if we had a good reason to think that it might go up a certain amount or down a certain amount. So we could say, okay, what if we go to the day after earnings when the market starts trading? What would we expect to happen with implied volatility? Well, would we expect it to probably drop, get that volatility crash? News is out. Whoosh, comes the implied volatility out of those options. Yeah, we would expect that. And so you can do some what if analysis here. There was an 11% difference between the two that was separating it, but you would expect actually probably a little bit more implied volatility to come crushing out of it. I'm going to kind of put this together here, because further out here, it's about 48, 47, this one's 50. So it might come crushing down to something similar to these levels, maybe by the end of the day. But initially, there'll be a big crush come out of it. Okay. So let's just, for the fun of it, let's say if implied volatility, where did you go? Kind of, there it goes, right there. Let's just go minus 10%. It's our best guess. We don't really know. We'll put a minus. Get rid of a bunch of stuff. Minus 10%. It's looking like 100%. Maybe if I can move this build a little bit. Oh, it's not really Not sure why that field is not adjusting like I would want it to, because you should be able to go in and adjust for implied volatility. Usually I'll put in minus 10%, 15%, whatever you think, okay? There's a possibility here. Let's see what your other questions are here. R1 says, could a simple straddle strangle work for this? Or would that be, quote, expensive? It definitely is more expensive because you're buying two long dated options that are priced full of implied volatility. And what we're trying to do with this double calendar is kind of capture, if we will, if we can, capture a lot of that implied volatility once the announcement comes out. And then hopefully the stock moves one direction or the other close to our strike prices. Obviously, we can't control it, but that's what we're going to watch for. So Riceburg's just following up, so we could close the trade early if it's positive. You can do whatever you want, absolutely. You could say, if I've already made 40%, or maybe you put on, say, 3 contracts, and you go, hey, I'm happy. Let's take 2 of them off. I'm happy with that 40% and kind of see how the rest of it plays out after the earnings announcement. Leave one in there. You could certainly do things of that nature. Okay. You wrote a book, John says. You wrote a book to me. Am I missing something up here higher in a book you may have written to me? I'm not seeing a really long note here, but maybe you did. I'm not sure. All right. Any other questions? How many of you feel like we went through this detailed enough that you could attempt to do a trade like this in your paper money account and just kind of observe it? Okay, you can just kind of sit back and say, let's just see what happens here. Let's just see the vol crush. Let's just see if it moves about what the price of the straddle was that's priced into the options. That's the way that, I practice with this strategy. Was I said, I'm just going to go do some paper trades with it. And that's how you do with any strategy, and you kind of come up with some guidelines that you try to follow that you think are helpful. I know this was not like, I'm going to move my note back over here so you can see this, okay? Just kind of some of the guidelines that we were using there. I didn't put the exit rules in here, but the exit rules would be, if you get a gain and you like it, if there's a gain before announcement, go ahead and get out. After the announcement, wait for the vol crush and then see if it moves to one of your strike prices or not. Maybe you end up closing down the losing trade. Not always is it going to stay in the initial direction the stock moves. You guys have seen that happen before. And so, maybe watch a little bit to see if it looks like really it's going to stay at that area. Like if the news was really that bad, or if the news was really that good when those earnings came out. All right, you guys. I hope you've had a little fun with me here today. This was definitely a working math brains type situation here. Okay. But I will probably give an update on this in one of my classes next week after the earnings are announced. So it won't be in the Monday or Tuesday class. It'll probably be in the Thursday class. But we'll be able to go and take a look at it and see how the trade is playing out here. Now, one thing I always want to do is show you how to find our content in our Trader Talks channel. So become a subscriber, click on that little blue subscribe button down at the bottom. It looks like YouTube in a blue font. Okay, their little logo. And then you have access to our different playlists, different lists that we come up for you that might not necessarily be a class playlist, like this one's bite-sized content. Barb's been doing some of these with some candle figures. I've been doing some of these with quick tips for Thinkorswim for those that are new to Thinkorswim and trying to learn how to do some of the really cool stuff with it. Just kind of taking a little section here and there. Scott Thompson's been doing some, you can see here, they're kind of around 8 minutes. So they're usually about 10 minutes or less, okay, on these bite-sized content. So I'm just going to encourage you, follow us, be a subscriber. And today, if you wouldn't mind, fill out that survey for us. We really do appreciate it when you take the time to do that for us. And again, I will read everything you write. And if you want me to pass something on to Durant, I'm happy to do so. If you want to say something to me to say, hey, cover this in your class, Connie, I'm happy to see that as well. All right, you guys, we're going to have a little break in our programming. We'll start up right again at the top of the hour. However, I forgot to pay attention to who is following me. So go to our calendar. We could go to this post real quick, maybe. We could come up here. We could come to the post where we have our calendar. And here we have advanced options, market movers. That's right. Market movers is going to be our last class of the day. So head on over there at the top of the hour. Thanks, everybody. Thanks, Barb, for helping me out in the chat. We'll see you pretty soon. Bye-bye.